Ladies and gentlemen, good morning, and on behalf of the company, welcome to the Magellan Financial Group 2014 Annual Results Presentation. I'm Craig Wright, the Head of Investor Relations at Magellan. The company's results will be presented today by the Chief Executive Officer of Magellan, Mr. Hamish Douglass. Please note there will be a question and answer session at the end of the presentation, so we would appreciate if you could please hold your questions over until that time. For those of you joining on the teleconference, you'll be placed on mute until the beginning of the question and answer session. The conference administrator will advise you at that time how you can ask a question. Please also note that today's presentation will be recorded. Thank you, and I would now like to welcome Hamish to take you through the results. Thanks, Hamish.
Thank you very much, Craig. It's great to see so many familiar faces in the room. Before I start on the presentation, I just may talk about what the vision of the group is. Brett Cairns, who's here, is our chairman. We've also got Rob Fraser, who's one of our new directors in the room. We've been very clear for some time we want to build a world-class asset management business. At this stage, we don't believe we have a world-class asset management business. We regard we've got a relatively small asset management business in a global sense with around 25 billion of funds under management. And world-class isn't all about size at all. It's also about capability that you develop, and it's also about sustainability of the business. There are groups around the world that we think have developed outstanding asset management businesses, and I think we've got a long way to go, but I think we're off to a pretty good start here at Magellan. So in no way do we're complacent about what's going on at Magellan. We think there's still a lot to do, and there is still enormous opportunity for Magellan in front of us. So in no way do we regard the group as mature in any sense. Of course, some of our existing strategies may be more mature in minds, but this is part of a long-term journey, and we're continuing to develop capability and investing in capability for the future. Some of that we will give you some sort of hints about. We're not going to go into a lot of detail for things that may happen 5 years in the future. And if you look at some of the things we're developing, we've been talking about, or yesterday I put out in the CEO's letter telling people about our Global Plus strategy, which is effectively a follow-on strategy for institutional investors. For our global strategy, we've never highlighted that before, but that strategy was put in place over 2 years ago, and we haven't yet got any clients in the strategy. So we had developed and invested in a strategy years before we thought it was going to be relevant to closing our strategy, and we are currently developing maybe follow-on global equity strategies for eventually when we close our current global equity strategies, and that's why we're investing in capability. So why don't we start with the results? I think it's fair to say that we had a satisfactory year last year from a financial perspective. Our net profit after tax of $82.9 million. In this slide, we're saying it's up 71% because last year we actually had a gain on our distribution of our shares in the Magellan Flagship Fund, actually, which had nothing to do with our operating results, and that was an $18 million after-tax gain. So if you took that out of last year's results, our profits were actually up 71% year on year, and that's also in light of a year that there were about $26 million in performance fees we earned net last year compared to this year. We sort of had 28 last year, we had 2 million this year. So notwithstanding that the in-specie gain was a one-off last year and we had substantial relative performance fees last year, the profit result this year I think was very satisfactory and was ahead of last year's, materially ahead of last year's result. And last year's results had a big one-off gain and had a lot of performance fees. So I think pretty satisfactory from our point of view. The earnings per share, 48.9 cents fully diluted, is an increase of 67%, again excluding that in-specie distribution. The dividend is up 78% year on year. The reason why the dividend's running ahead of the underlying profit increase is because of really the asset management business. There were probably some more gains at a corporate level that we don't take into account of the dividend. And another driver of the profit this year is the reduction in the effective tax rate from 30% to 24.9%. And that is because of the status on 1 July, I think it was, or 31 July last year, when we got designated an offshore banking unit, and our offshore revenues after allocating relevant expenses get taxed at 10% rather than 30%. The balance sheet is in very good shape. We've got net assets of over $200 million. That's up 35% year on year. Our funds under management at year end were up 60% to $23.5 billion, and our July end funds under management were nearly $25 billion. The average funds under management, which really drives your fees for the year, were actually up 104% over the year, and our total staff has increased to 69 people at year end, up 19% year on year. People are obviously well aware, who have followed us, we have two fundamental businesses at Magellan. One is our core asset management business. Magellan Asset Management is a responsible entity. It actually employs all the people. And then we have our balance sheet being our principal investments that I'll also talk about. And we actually manage them quite separately. We're continuing our dividend policy that we've announced for a number of years, intention to pay out 75 to 80% of the underlying profit of the asset management business. That includes performance fees. So the dividends could actually fluctuate from period to period if there are performance fees earned in a period. Importantly for shareholders, as we did with the interim dividend, we have brought forward our payment of our final dividend by over 1 month, and we're going to pay the dividend on the 1st of September this year. A shareholder sent me an email yesterday, and he said he thinks we're setting a world speed record for the payment of the dividend. I don't know if that's correct or not, but we believe in net present value as shareholders. People have a discount rate as an equity investor, probably at 10% or so. We can earn you maybe 2% on holding that cash in the group. It makes a lot of sense for us to get that cash into your hands as soon as possible from a shareholder value perspective. Maybe other companies could take note of speed of payment of dividends. I don't think we can do it any more quickly. I would have loved to get this into August, but this is as fast as our systems enable it to be paid. The offshore banking unit I've mentioned, it has reduced our effective tax rate. Remember, we only had this for 11 months of the year, and if you look at our accounts in detail, we actually give you the breakdown of our revenue, so you can get pretty approximately what our offshore banking unit revenue would be. It's not exactly correct because not all of it applies to the offshore banking unit, but of our total revenue management fees last year, 32% came from offshore sources. And if you roughly did that calculation, you'll get close to the effective tax rate. It's actually a very complicated allocation of revenue and expenses, as Nerida would tell you, and also Kirsten, our CFO. And that's had a benefit for us of over $5 million after tax last year in the reduction in the effective tax rate. I'd like that to keep coming down over time, but that all comes to our revenue composition. Now, our funds management business, if you look on this chart, I think probably one of the most important lines is what happened to the core management fees. And the core management fees were up from $56 million to $132 million, so they're up 137%. The profit before tax was up over $100 million, so $102.5 million from $61.6, so it was up 66%. If you stripped out the performance fees both years, the profit would have been up, and you can't exactly do that because of expenses, but if you did it broadly, and stripped out the effect of performance fees, the profit would have been up over 200% year on year in the asset management business, and I would regard that as a pretty satisfactory result. Average funds under management, I mentioned before, up 104%, which largely drove the management fees up 137%. Importantly, we look at our cost-to-income ratio excluding performance fees. Last year, our cost-to-income ratio excluding performance fees was 43%, and this year 26.7%, which of course translates into a relatively healthy operating margin at Magellan. Hopefully we'll get close to 75%. We don't manage the business trying to manage it to a margin at all, but we do have a business that has a lot of operating leverage in it. Funds under management, this is something we disclose. I don't think I need to go into a lot of detail on this. Global equities is about $20.5 billion at the end of July. Our infrastructure business, and Gerald, who runs infrastructure, is here today doing a terrific job in that business. $4.2 billion, giving total funds under management at the end of July of $24.8 billion. And that is up very substantially from the end of June 2013, which of course was up very substantially from the 2012 year. Capacity, and this is a topic that is not that well understood in the community. We have said to the investor community at Magellan, our capacity is around $50 billion in our infrastructure and global equities business. We have not previously given the breakdown of how we get there. The global equities approximate capacity is $40 billion, and that's actually split $30 billion in our current global equity strategy and around $10 billion in what is known as our Global Plus strategy, which is the follow-on strategy, slightly higher market capitalisation. We are closing the current global equity strategy for new institutional separate account investors, and that means an investor that would invest over $200 million with us on the 31st of October this year. And from that date, we will offer people the opportunity to invest in Global Plus. They are virtually identical strategies. They may not always have exactly the same stocks, but they are very, very close, and they track very close. We are not, in conversations we're having with prospective clients, we are not having any pushback, and we're not anticipating that it's materially going to change the appetite for our global equities offering from the transition from global equity to Global Plus equity. And our infrastructure number is around $10 billion. The part of this that isn't well understood, I think, in the investor community is that this number really gets indexed over time. This was a number we were effectively cutting at a point in time. What's important for us as an investor that our opportunity set remains the same in terms of the strategy. So if markets go up in time, the market capitalisations of our investment opportunity set will also rise, and that means our total capacity should broadly index with markets over time. And we've just, for an illustration, and in no way is this a forecast, we've said if markets went up at 7% per annum over the next 5 years, that $50 billion in our current capacities would probably be $70 billion. And we look at a number of the analyst models that look at Magellan, and at $50 billion we suddenly end up with no more business. Even if we didn't take another dollar today, we will grow with market growth or our performance growth, whatever that happens to be. And again, we won't make a forecast, but we do run a strategy that has an objective of 9% per annum net after fees. If we achieve our objective, obviously there's a payout, a dividend payout, so you'd have to think about some clients will take their dividends in cash, so it would be our growth would be somewhat less than that over time if we achieve our objectives. So we were just wanting to make that clear. We previously said it would be indexed over time, We're a little bit too cryptic in the past, I think, in what we meant by indexing, so we're trying to be very clear what we mean, how we think about it, that this capacity from the current strategies we're running doesn't remain static over the longer term. And we would expect, even though equities have cycles, over the longer term, the line is probably upward sloping in terms of equity returns. It has been forever in time and history, and it's likely to continue doing that. But we'll have cycles where periods equities go down as well. The employee part of the business, where we've increased our headcount from 58 to 69 people over the year. You can see we hired a few more people in the investment team, 2 more investment analysts. We made a marginal increase in distribution during the year, but we added quite a bit of capability around our business support and control. Craig, who's head of business development, investor relations, joined. Jeff, who's joined as our company secretary, and other areas. We've been investing in some very, very high quality people in the business. We have outlined yesterday that we expect in the 2014-15 year for staff expenses to increase by 30 to 35%, and year on year they were up 35% last year. The reason staff expenses are going to increase at that rate is really a factor of 3 factors. The first factor is we had people who joined us last year who were only with us for part way through the year, and therefore we only paid them for part of the year. This year we'll pick up a full year cost for those people we hired last year. So of course that's going to factor in. People are doing a terrific job at Magellan, and you would expect us to probably pay people more year on year as they're progressing and developing at Magellan. So there's a remuneration increase that would be pretty standard. And also we have plans to hire people in the business. The biggest part of the investment next year is actually going to be increasing the size of our investment team. And we are building out our investment team in some areas, and we've already hired some people who haven't joined at the moment. And this is really investing in capability for the future of Magellan, because we are designing follow-on global equity products that are very, very closely aligned to what we do at Magellan. And we effectively need a deeper research capability in order to do these. These products may not be launched, they certainly won't be launched until we totally close our global equity strategy and the Global Plus strategy to institutional investors, and they'll only be launched, there's an if there, we may decide never to launch these products if we're not happy with them. Well, they're very closely aligned, so I think the probability is reasonably high in the future. But we're investing today. For reality, these things are unlikely to have any material contribution to Magellan. They certainly won't be launched for a number of years, and even if they're launched, it will be a number of years after launch before they would have any track record or materiality to the group. So reality, this is probably something we're investing today for something we're really thinking about 5 years down the track. And any of those products or extensions is probably a better word to what we're thinking. The capacity of those products would be incremental to our capacity. And it's probably worthwhile thinking, if we end up having 50 billion plus of funds under management, I'm not doing things that would have 1 or 2 billion of capacity in them. We're only doing things that could be material in the scale of a business that would have 50 billion in funds under management. I'm not going to say any more about that because it's simply not relevant to the financial outcome of Magellan for at least 5 years into the future, but I want to put the investments we're making in people and systems and capability into context of why we're investing for the future, in case people are concerned that I've gone nuts increasing our cost base by, our employee cost base by 30 to 35% next year. Myself and the board and senior management are really delighted with the calibre of people that we're bringing into the organisation. Let's start with the retail business. The retail business funds under management grew by nearly 50% last year, from $4.5 billion to $6.7 billion. It was actually slightly better than that because the $4.5 billion included MFF, and then we reclassified MFF during the year as not funds under management because we changed the arrangement, which sort of took broadly $500 million out of the numbers. Very importantly, the average monthly net inflows is something we look at. And for 2014, the global fund has been averaging about $150 million per month. It fluctuates a bit and there is some seasonality. And then we add our other retail businesses, our very important Magellan Infrastructure Fund, and then the High Conviction Fund. And our total monthly average retail inflows are averaging, 170 to 180 million per month. And there's a little bit of fluctuation, but it tends to be a very, very steady business because we have now over 7,000 advisors using Magellan on average every month. It's incredibly diversified of where that business is coming from. And we're not saying that it will maintain at 150 and 170 million per month. Frankly, we don't know. There are a whole lot of factors at work, and we'll talk about some of those factors in just a moment. New funds that were launched, people know this, we launched a hedged version of the global fund, very small demand while the currency's high. If the currency falls, we expect it is really just giving people an alternative as the A-dollar moves around. It's exactly the same product. The infrastructure fund has been a hedged version. They've launched an unhedged version, so both choices are available in infrastructure. And then the High Conviction Fund that was launched on 1 July last year. That's a 8 to 12 stock portfolio. We have done very, very little marketing of that product at all. It's much more bespoke. It's for the high net worth part of the advisor market. Funds under management, 129 million. The performance has been very good in that product. We're happy to grow that slowly over time. A bit of a pet project of mine, but we've been very happy with how it's gone to date. But not material in the scheme of Magellan at this point in time. Performance. This has had a lot of attention at Magellan in the last 12 months. The relative performance of the global fund over the last year, relative particularly to the MSCI World Index, and people have followed us closely, we produced a return of 11.7% over the last 1 year. Over the last 5 years, we've compounded it after fees at nearly 17% a year. I can tell you our 3 and 5 year numbers are close to the best in the world. We are kind of number one over 3 years and 5 years versus nearly any way you want to cut the peer groups of managers. Over the last year, we've seen quite a divergence between us and a broadly based peer group, and certainly versus the world MSCI. And there's been a lot of commentary, I guess some nervousness, that that's going to affect the inflows related to Magellan in the market. What I would say to you, it's been a very extraordinary period. We are a low volatility manager, and actually when you look at our investment, we're large cap, low volatility. So versus the world MSCI, there's 8% difference between us and the world MSCI over the last year. Compared to the MSCI World Minimum Volatility Index, we ran right in line with that. We didn't beat it. We'd like to beat it. We didn't beat it. So I'm not saying it was fantastic, but it was much more in line with that. And the Dow Jones Index in the United States, which is a large cap blue chip index, did 12% compared to our 11.7. So compared to large cap US quality and compared to minimum volatility, our performance was actually right in line with those other indices. We actually look nothing like the world MSCI at all. It actually has almost nothing to do with what we are doing at Magellan. It has nothing to do with our investment objectives. It has We are 20 to 40 stocks. There's whole sectors, countries and things. We just look nothing like that index. So it's kind of an interesting comparison to look at. But if you look at what's more style like us, our performance was actually much more in line with the style of what we are doing. And if we compare ourselves, which I'll come to, compared to our true peer group, our peer group is actually a very different group globally than you may think it is in Australia. And our true peer group globally, who are quality and lower volatility, our performance was broadly in line with all those managers. At a retail level, and I'll come to this, at a retail level, is it going to affect our business or flows? The first thing I'd tell you at a retail level, we have over 7,000, probably 7,500 advisors. And I often ask Frank Casarotti, who runs distribution, is what is your team hearing from the advisor community about the relative investment performance? I think we have had less than 5 phone calls out of 7,500 advisors who have asked a question about the relative investment performance over the last 12 months. There have been a few of those 5 people who have been irritated by it, who are concerned by it. So I'm not saying it doesn't exist. There are a few people, and there could well be other people who haven't contacted us. And certainly there would be our competitors in that advisor space who will be proudly pointing out the relative performance difference to advisors in the market. I think there's a few facts of why there has been so little concern being raised by the advisor community. First of all, if you take a 3 and 5 year view, we're kind of number one in performance. The advisors clearly understand what our product is, and our product is to protect people on the downside, to have lower volatility. And we have defensive bias built into our portfolio, and we have always told the advisors in strong up markets we will underperform a strong up market, and we will make no excuses about that. That is what people should expect, and we've communicated that for years to people. It just happened we went on for years where it wasn't really happening. But it's happened, and people, I think, really do understand that. We don't go out and say our objective is to beat the index by 2% per annum or something. We say our objective is to protect you on the downside and to deliver a through-cycle return of 9% per annum. Our return last year was actually above the return expectation that we have communicated to the advisor community. And if you look at our performance over time, it translates, because this index is nothing like us, we have on average an 8% variance from that index. There are periods where we're 20% above the index because we look nothing like it. Being 8% different from the index when our tracking error is 7.9 is right within the middle of the pitch, to be honest. And the other thing that I would say in terms of likely flows, and it's hard to predict, our support base just continues to grow in terms of the advisor community, in terms of number of advisors using Magellan, and which I'll talk about in a minute. We are making substantial progress in very important bank-aligned channels where we actually have a very small share. And if anything, we are going to have more advisors and more penetration in the next 12 months to 24 months, which may offset any weakness that people would say. So I'm not saying that our flows can't go down and won't be influenced by relative performance. We're just not seeing any evidence of it in our business to date. We're not getting it from advisors. We're not seeing it from behaviour. We're not seeing it from flows at the moment in the business. I can't tell you what people will do over time. The performance of the strategy, to be honest, we haven't been perfect in the last year. There's been some individual stocks that haven't been brilliant in the short term, but the overall performance of the strategy, from my perspective, is in the centre of the pitch of what it should be in these type of market. So this whole thing that Magellan's underperforming, we don't feel we're underperforming relative to any index that looks nothing like us. People may think of it relative to what we're trying to do and what the strategy is. The strategy is doing what it should. Is it outperforming in the last 12 months for what it should? It's not outperforming, but it's not really underperforming either. And just as an anecdote, I'll give you a very large asset consultant, probably our largest asset consultant we have. We had a review probably 4 weeks ago, and we were talking about a lot of things, and then we got on to performance. And when we got onto the performance discussion, the asset consultant said to us, "We don't want to discuss performance." I said, "Well, we're happy to." He said, "We don't need to discuss it. We have absolutely no issues with performance. The strategy is doing exactly what we expect it to do, and we are delighted with the performance of Magellan." So we're just not at people who actually understand our strategy and our business finding any real pressure. We're finding pockets for people who probably understand us less, but at large institutions, at asset consultants, and broadly across our advisor base, people really understand what we are, what we're doing. So, I'm not protesting about it. I'm just trying to communicate to people we're not seeing the evidence in our business that people are fearing in the equity markets. Of course, if you have very sustained periods of relative performance, it could affect the business. And where I'd say to you is that the thing that would worry us from a business point of view is if we underperform when the markets go down. That is us skiing off-piste. That is doing something that we are saying to our investors, we are trying to reduce the probabilities of protecting people's capital. So if you see us materially underperforming in a down market environment, I think your antennas should go up as investors in MFG. In these markets, it's sensible to have an antenna up, but it is we are not concerned about it from a MFG perspective. We're not complacent about it either. We haven't been perfect in the last 12 months, but it's pretty solid. What we've given you is probably a peer group we track more closely, and this is a peer group of really institutional asset managers that the asset consultants and clients believe that we are most like. So instead of being out by 800 basis points, we're probably within 300 basis points of the median of our peer group in the last 12 months, and we're right at the top of the peer group who run concentrated quality and lower volatility global equities. So people who are doing things much more like us and who we actually compete against for business globally. These are people we come up against for real business. So Platinum may be a business where we compete in the retail market. There's no chance we run into Platinum in the institutional market, just because we do very different things and we're looked at very differently in terms of when we would be in a pitch for something, they would be in a completely different pitch. We wouldn't be in the same race and in competing for business. And compared to our peer group, our performance last year actually doesn't cause asset consultants or anything any issues last year. I'll talk about our institutional business, and I'll make some comments on the pipeline as well in a few minutes. On the next slide, distribution opportunities. We're now, for the phone, we're actually up to slide 13. Sorry, I should have been mentioning, it's not a webcast today. Distribution opportunities, this is in retail. The first of all is we said at the half year that we were working on the bank AMP aligned advice market. So we have a very high penetration of the independent advice channels. Frank and his team has done an outstanding job in that. Our market penetration is extraordinary in that business. I would have a guess we probably have 90% of the advisors in that channel using Magellan. It's just unbelievable. But our penetration in actually the largest part of the dealer market is actually the ones who are directly aligned either one of the four major banks and AMP. And 6 months ago, we had one of those institutions where we were effectively able to do business with the core part, particularly their big financial planning. A number of these institutions have boutiques that we actually have good penetration, but the core of these businesses, the centre of the pitch, as I call it, these institutions are often very, very difficult to do business with because of their business models. And 6 months ago, out of these 5 institutions, we were only effectively fully available within models and on platforms and with arrangements with one of the 5 institutions. So notwithstanding the amount of flows and things we were getting, we only really had a core relationship with one of the 5. And don't forget, these people control 80% of the financial planners in Australia. We were missing a huge part of the potential market, notwithstanding the sort of flows we were getting. I'm happy to report to you we have now done deals with 4 of the 5 of those institutions in the last 6 months. We're not getting any business in the last 6 months because we haven't yet completed all the arrangements. But in the next 6 months, the other 3, so we had 1, 3 more of them, we would have completed all the arrangements for 3 more of them. And that will take us to 4 out of the 5. And we would expect after 6 months' time that we will start to get flows out of those institutions because we're able to do business with them holistically. And I'd also say we have done deals with those institutions on very mutually beneficial terms for both parties. And we are very, very happy. And if you ever meet, I talk about Frank, if you ever meet a man called Mark Burgess in our organisation, buy him a drink. It is extraordinary what he has done in getting there. You know, this is very, very difficult to do. The barriers to entry doing business with these banks is very, very high, and they normally want you to do it on draconian terms. We have not dealt on draconian terms with anybody. There's one to go. It's probably the most challenging bank. I'm not going to point them out by name, but there's one to go, and Mark won't give up until he has them all. And we, as I said, we expect to gain some traction over time. The last thing which we had outlined at the interim results was this whole self-managed, self-directed superannuation segment where you have got a huge amount of money in superannuation, in SMFS, that is effectively people doing their own investments. We virtually have no share of that market, and potentially it's the fastest growing and largest segment in the market. So we're getting $170 million a month with only one bank, not 4 banks, including AMP in that thing, and literally 0 of the self-managed superannuation market. So while everyone's concerned that our flows may go down in retail, we just see enormous opportunity to increase them. To be frank with you, how we look at the world, we are working on an ASX listed version of the Magellan Global Fund. If it is successful, and I should say we're working on it, it is very, very difficult from a regulatory position to actually get something that really works. And, you know, this almost would look like an actively managed exchange-traded fund. It's kind of the holy grail for fund managers in the world, and it really doesn't exist anywhere in the world. And the reason it doesn't exist is because it's really difficult to do. We're making progress. We're making progress. And if we're successful, and I put the big if we're successful, because it's hard, if we're successful, we believe we are, if we can do it, we're in a hugely privileged position to go after that market with the stockbroker community and then with the direct channels such as CommSec and E-Trade and others to go after that market. We think we have a brand advantage. I think we have a distribution capability to open up that market, but we have to have a form factor that works. The problem is these investors simply will not use an unlisted managed fund. It is a completely foreign concept. They trade in shares and they want to close the trade in live markets. We need a form factor that actually meets their needs. And if we have something that meets their needs, the opportunity is absolutely enormous for Magellan. But if we pull it off, I don't know. Craig, who's been on the team for a relatively short time, is leading the project. Brett Cairns, our chairman. Brett is dramatically underpaid, let me tell you. He's been working full time on this project as a non-executive chairman. His intellect is incredible. We think it is probably one of the largest single opportunities we have, but we don't know if we're going to get there, to be honest. But I'm just wanting to put it on the table that there is another element in our retail side of our business where we see just huge opportunities that are untapped. We've made a lot of progress in the bank-aligned channels. We're rowing hard on this other one. We'll see what happens. Let's talk about our institutional business. What a year! What a year from our team. Our total funds under management was up 66% in our institutional business, up from 10.1 to 16.8. It was really $5 billion of net inflows. The rest was investment performance. So $5 billion of net inflows, and don't forget that didn't include St James's Place. That came the prior year. So this was $5 billion, excluding what we had the prior year, which was that large mandate from St James's Place. Importantly, and I think our business is almost unique here, we currently have 80 institutional clients. Most Australian fund managers are dependent on 2 or 3 people of investing with them. We've got 80 institutional clients at Magellan, which gives us incredible diversity. Also, these institutional clients, you have to think about it, everyone has a different experience depending on when they invest. The timing of when people invest. Outside St James's Place, no one has a material amount of money. They're large numbers. We've got plenty of people with 500 million. We've got a few at $1 billion. We've got another over $1 billion. We've got St James's Place with nearly $5 billion. So we've got some big investors, but we've got 80 people, and most of these people all invest at different times. It's lumpy when it comes in, and therefore they all have a different perspective of how they look at their investments. Because depending on, you know what statistics are, it's point to point. So every time if you buy at a different point, you actually get a completely different return. And that's very important to our business, to keep building upon the diversity of the client base and keep building up the time difference in terms of when people come in to your strategy. So we think our institutional business is incredibly diversified and resilient. Our Australian we're really focused in 4 areas of the world now. Our Australian business funds under management was up 20% in the year to $2.9 billion. And to be honest with you, Australia has not been a high priority focus for us because it has been dominated by 2 large asset consultants, Frontier and Jana. A lot of respect for those organisations, but we haven't wanted our business to be dependent upon a concentration of asset consultants. And the Australian market is very, very susceptible to 2 large asset consultants, and if they change their view, they can just change the directions. Most of our institutional money we have has not come via asset consultants. It's come with direct relationships with people who make their own decisions. Very important difference, which helps the diversity point. In North America, funds under management up 62% year on year. We're getting close to $5 billion, $4.7 billion, net inflows of $1.7 billion for the year. We have just made a strategic decision to split Canada out from the United States of America. And I have 2 extraordinarily talented people we're putting on that project. One is Serena Calapese, who has on her own led our UK efforts. I think it's one of the greatest achievements I've ever seen in my life. And now we're going to unleash Serena on Eastern Canada. And she hasn't been at it for very long, but all I can tell you, well, what a start she's had. We're talking to all the biggest people in Canada, and we've got a great prospective pipeline of potential. We've got 700 million there. I would like to see Canada be the size of our UK business, and there's no reason in the world why we can't. It's a very, very attractive market. We also have another gentleman, a man called John Dewey, and John Dewey is our first institutional relationship person we've hired in the United States. We have a relationship with Frontier Partners, but we're starting to build out our own relationship team in addition to Frontier Partners in the United States of America. John actually lives on the west coast of America, and he'll be looking after Western Canada as part of his brief. And over time, we will build up our own distribution force in North America. Over time, that's a longer-term project. The relationship with Frontier Partners is still incredibly important and very strong, and they are doing a fabulous job. So this is a partnership we're going to have between Frontier Partners and Magellan, but we're starting to build up our own team in America. It's going to be very steady. It's going to take a number of years to do that. But Canada is very closely aligned what we do in the United States, very similar thought process, and actually a very, very large market for us. On to slide 15, the UK up 65% year on year. Funds under management are now 8 billion in the UK, and that's end of June. It's actually nearly 9 billion today. So incredible, $9 billion with one relationship person based in Australia. It's just incredible. I think if dames and knights are being handed out, give one to Zarina, in my view. If you're one of the things that add value to the country, we're getting all this export income into the country. The net flows were $2.5 billion. St James's Place is at $4.8 billion. Fabulous relationship. I had the managing director of St James's Place in my office this morning, and we're talking about things of the future, and we both see an enormous bright future in the partnership between Magellan and St James's Place. The Core Infrastructure Fund, $2.2 billion. Gerald and Dennis and Zarina, they've just done a terrific job in that market, have a wonderful strategy being run there. It's a specialised fund that's been set up, and it's had just incredible client interest in it. And then the Magellan Global Fund, the UCITS fund we launched, I think we launched in October last year, and it now has $1.2 billion in it from launch in October 2013. Look, I can't say much more about this other than I'm absolutely delighted in what the team has achieved in the UK. I suspect the rate of growth in the UK is going to slow down materially because we actually have a relationship with the people who have the most money. So, we've done a terrific job in that market. But Zarina will find plenty of things to do in Canada. Let's wish her well. In terms of, we put this slide up because a number of our institutional clients have underlying businesses where they keep putting more money in every month. A whole lot of the big accounts, you get one piece of business, and that's the piece of business. You just get market growth. But we have accounts like St James's Place. We have relationships with other groups around the world who are institutionally oriented, who give us money every single month because that's their business model. They're in inflows. We get a share of the inflows. On average, that has run from institutional business $162 million a month. Our retail business actually averaged last year at $178 million per month. So regular business, on average, is averaging $340 million a month. So before we win another piece of a new client in the business, we're averaging over $300 million a month on average from people who are regularly giving us part of their business. And, if you translate that, that's probably $3.5 billion a year without us winning a single new client. Of course, you can have variations in this, but that just shows the diversity of what the team has built up here at Magellan across our institution and our retail client base. And frankly, I don't see a lot. We can get some variation in that, but what's going on, I don't think a lot's going to change in that regard in the years ahead. In terms of our institutional pipeline is solid. In fact, our institutional pipeline today is as strong as it was 12 months or so ago. I don't know what it's going to translate into the next 12 and 18 months. It is lumpy. Some of them are large, some of them are smaller. They're driven by their own internal factors, but the depth and quality of it is as good as we've ever had it. And I'm not going to make any predictions about flows out of institutional accounts, but the pipeline is strong, prospective, and solid. And we will see what happens over time. But it's not like we've got to the end of the road. We are dealing in a market. The world is incredibly large, and we virtually have no market share. And therefore, there is always big client opportunities when you take a global focus in our core markets of Australia, the United Kingdom, Canada, and the United States. We've got a smaller presence in Singapore. The last part of the presentation is principal investments. The reason we have our principal investments business is really for three reasons. First of all, it provides the capital to seed new funds. If we do this listed product, we're actually going to put up quite a lot of capital to seed that business. It's very important for its liquidity. Actually, having a balance sheet that you're able to do that is strategically important for the group. The second one is we are a publicly listed company. Not all clients like investing with asset managers that are listed. It's very important that we can make a strong statement to our clients that this public company is aligned with them with a substantial investment of virtually all of its capital invested in the funds that we manage. So it's very important. And the third part of it is this really provides the group with liquidity. You know, we are running, at some point in time, something will happen where we may have to compensate clients. We want to make sure that we have very substantial, we hope it never happens, we run incredibly good compliance systems, but it's the nature of the game you're in. And if you're running $50 billion or something, relatively small things can actually add up into large dollars. And having plenty of liquidity and capital is strategically important to where we're wanting to take this business in the longer term. Of course, we want to try and do it in a way, to the extent we're carrying this liquidity and capital, that we earn a decent rate of return on it. The board has established a return hurdle of 10% per annum pre-tax. It's not each and every year. So we've largely invested in our equities products, and our equities products broadly have a 10% per annum objective in it. Of course, we don't pay fees to ourselves, so broadly pre-fees, our objectives are around 10% per annum. And if you look over time on this slide, last year did 13, over 5 years we've done 18%, and actually since inception taking out MFF, and the reason we took out MFF is because we actually spun it out to our shareholders, and at that point its share price is much higher today, so the shareholders have got the benefit. So it's kind of misleading when we gave it to our shareholders when it was kind of undervalued. But if you strip it out, right from the inception, we've done like 8.5% per annum. And given the markets, this was just at the peak of the last market, I think we've generated a very decent and acceptable rate of return on this strategically important asset that we hold on behalf of shareholders for the group. I would mention in terms of the portfolio, it is incredibly clean, the portfolio. It is largely just invested here in our funds. We've got $10 million in listed shares. That's actually, I've just lost the slide. That amount of money of $10 million is actually the fund we are running of the Global Plus strategy. So we're not running a separate portfolio of punting some shares. We've actually been running for quite a period of time this Global Plus strategy on our own balance sheet before we ever take. So we've got a track record to take out to our clients. So this portfolio is just completely aligned with what we're doing in the business, and it's very, very clean. With that, I may wrap up the formal presentation